So what we want to talk about today is yields or interest rates. Let's start off with that basic statement. I'll use this letter I to represent a yield or an interest rate, not a number of dollars, but a percent. We could calculate a yield or an interest rate or rate of return. There are three different terms. We could calculate that on various types of investments. We'll mainly be talking about bonds in our particular applications, but you could calculate that for stocks and in theory any other kind of an investment. The way I stated this last time is we've got a standardized way of talking about interest, and the standardized way that we have of talking about it is to say the return to the investor per $1 loaned or invested per 1 year. And the reason for that is investments, whether it's bonds or stocks or an investment in real estate or whatever, investments are of all different sizes and for all different durations or terms. And since they're all different sizes, then we can't make any direct comparisons between yields or returns unless we do something to standardize that. And so what we'll do is we'll divide it. If it's $1 million investment, we'll divide the return a million ways to get it down to per $1 worth. And that way we can compare it to a $50 investment, which we would divide 50 ways, our return, and say, how much do I get per $1 worth of investment? Same thing about terms. Some are short-term investments, some are long-term investment. We'll standardize that and say, for 1 year's worth of this investment, what would be my return? And so then if we get a number that says 0.04 in our calculations, that would mean we're getting 4 pennies, 4 cents per $1 invested per 1 year. Okay? And then we would express that as 4%. And this way, of course, moving the decimal over and adding the percentage sign. Now, we'll build this up, but this is just the interpretation. And what I would add before we go on is we're going to end up with a calculation with our calculators out and punching buttons. And the important thing that you know is this, on almost any kind of calculation, when you were in grade school and things like that and you were learning mathematics, just being able to do a calculation was the point of everything. But now, at this point in your life, when you do a calculation, nobody's giving you calculation just saying, hey, can you punch those buttons and get this number? Now, it's the interpretation that's so important. Being able to punch the buttons is the thing that you've already got that skill. And now, when you get that number, it's, how do I interpret that? What does that mean? And that is really what this is about at this point. You're going to have a number, and you don't want to just say, oh, 0.0386. Yeah, what? 0.0386 is what? And you need to be able to say, here's what that means to me. Now, the way we do this is we have a fraction, and in the numerator of their fraction, we put the annual return on the investment, and in the denominator, the size of the investment. Okay, so all we've taken is this sentence, the return of to the investor per $1 loan per 1 year. We took that sentence and turned that into a fraction, which now we still need to flesh that out some. But you see here where we've got annualized returns. We've already, you know, when we go to our formula, we're going to have something annualized in the numerator. And by dividing that annualized return by the size of the investment, we will divide that down. If it's $1 million investment, we're going to be dividing that return a million ways to get $1 worth. If it's a $50 investment, we're going to divide by 50, whatever that return is, to get it down to per $1 worth of investment. And now on this, in this annualized return, we have two kinds of returns that investments provide us. Okay? And one is just this. And to go back to the bond, we can generalize the statement, but coupon interest per year, I should say annual coupon interest, okay, plus annual capital gain. That is to say, a capital gain would be an increase in the value of the investment, its market value. And the size of the investment, we're not going to change that. And I'll write it slightly differently, amount invested. Again, we're just expanding each one of these terms. When I say something about the return, I want you to know there are these two components. And now let's talk about that coupon interest. I'll draw a bond. Okay, we'll put a face value on it or a maturity value. We'll put a coupon interest rate, let's say 5%. And we'll put a maturity date, let's say 5 years hence. So whatever today is, plus 5 years. Okay, so now, from this example, here's our annual coupon interest. It's the coupon interest rate times the par value. And so here would be 0.05 times $1,000 equals $50 a year. That'd be our coupon interest. Okay. How about our capital gain? How much? Can we tell from this? There's a missing piece of the puzzle here that and I'm going to fill in this missing piece of the puzzle, or provide it, I should say. But right now we can't, because here's what we know. 5 years from today, here's what the bond will be worth, $1,000. You'll cash it in. By cashing it in, you'll hand the bond over. They will say, here's $1,000. Thank you very much. But the other part of the story is how much you pay for it. If you buy that bond today, hypothetically, buy today for, and just an amount of money, let's say $900. You purchase this bond, you write somebody a check for $900 right now. Now we have the information. Here's our capital gain. It's the par value minus the purchase price, right? Our par value is $1,000. Our purchase price, $900. I'll write that in, 1,000 minus 900 equals 100, yes? But annualized. We've got to have an annualized return, because that's what we're asking for here, per 1 year. If we buy this today for $900 and it goes up to $1,000 between today and maturity, that's 5 years to get that $100. We don't get that $100 this year, right? Here's time. Today, 5 years hence, we pay a $900 for it today. It goes up to $1,000 here, and each day there will be a fluctuation in the price, but over time that price will move up along that line. Someplace, sometimes a little above, sometimes a little bit below. But over time, if we buy that here, and in 5 years from today we have $1,000, we've got a $100 capital gain. But it says here, annualize that on an annualized basis, 5 years. And that's $20 a year. So let's do our final calculation now. Our interest rate on this bond is the annual capital gain, or annual coupon interest, $50. Our annual capital gain, $20. And how much did we invest in this? How much did we invest? $900. So we have $70 income per year on average from a $900 investment. And that is, oh, it's a very lucky number here, 0.077777 equals 7.78%. I'm rounding off. And so what that says is, if I buy this bond today and hold it until it matures 5 years from today, I buy it for $900, it goes up to $1,000, that I'm getting almost, not quite, 8 cents per $1 invested each year. And this would be referred to as a yield to maturity. Because we're calculating it, what's your yield, what's your rate of return if you buy it today and hold it till maturity. Now, this is somewhat imperfect. I wouldn't call it a rule of thumb, but it is a formula that we can do in a fairly simple way. The problem with this in real life is that when we talk about the amount invested, how much is invested in that? Okay, it's true that we invested $900 on the first day. We got 900 in the denominator, but what's happening over time is that at any point in time we could sell this bond. And so if on this particular day you could sell the bond for, let's say, $930, on that particular day you say, I could sell this for $930, but I'm leaving my money in there. What you're leaving in there is $930. And so the amount you have invested that day is $930. And so it's really changing over time. And so to some extent, I mean, this is, the math is correct, and the model is correct as far as it goes if we understand what we have. But what we have is something that's a little bit imperfect here. Okay? There's a more exact way of doing this, but it's not an easy way of doing it. And it's a lot easier to do if you had your calculator. Okay? Let me calculate present value equals, and this will just be the formula. You've seen this formula before. We're going to take the future dollars this generates, $50 divided by 1 plus I to the first power, plus $50 divided by 1 plus I to the second power, and so forth. If you were calculating the present value, that's the way you do it. And then over here on the left-hand side, because we know this, here's the price today, its value in the marketplace is $900. Right? $900 is the value in the marketplace. And that value in the marketplace is all these future receipts that we're going to have from the bond divided by 1 plus I to the t power. There's only one unknown in this formula, and the unknown is the I. And so what we could do, we could spend some time with this with a calculator. I could do it in a couple minutes with a spreadsheet. But just through a sort of a hit and miss, we could put in various interest rates, or, like 7%, 8%. 7's a little too low. 8's a little too high. And then we'd just start trying different numbers. And there would be a number, an interest rate number, that would make this statement true. 900 equals all that stuff. Well, that's not fast, but that's exact. But that's not fast. It's not something you're going to do like if you're just, sitting down maybe at the bank or something like that, or most of you are not going to do this ever. But it's more exact. And so what we do instead is we use that formula that we've got down there for yield to maturity, and that's the one we'll be using. But I do recognize that it's a little bit of a fast method that's not right out to several decimal places. But it's pretty close, and that's what we'll do. That's what a lot of people do, most people do, that are calculating these yields. Now, here's how we would change this. Well, I'm not going to tell you how we would change it because I wouldn't change it till I get to the next formula or the next concept that we want to talk about. Anyway, are there questions about this? Here's why that wouldn't work with a stock. And I started to say, hey, how would this work with a stock? With the stock, you could say something about, what's my annual coupon interest? That would be like a dividend. It's not coupon interest, but what's my annual dividend payment? And then with the stock, you could talk about your capital gain, but only over a certain period. Like, hey, I bought that stock 3 months ago, here's where it is today. Or I bought it 3 years ago, here's where it is today. It's a gain, but it's not really calculated to a maturity date because the stock doesn't have a maturity date. And by the way, we may buy a bond and not hold it to maturity. And so that really is what leads us to this next idea. What if I don't buy that bond and hold it for 5 years? What if I buy this bond and I pay $900 for it? But what if I only hold that for not 5 years, but 3 years? Then what? And so the concept that we have in this particular case is a holding period yield or a rate of return. And we've got the same general things in this formula. Here's our annual coupon interest plus annual capital gain. And divide by the amount invested. Now, in this particular story, I'll change as little as possible. It's the same bond. We're going to buy it for $900. But let's say we hold it for 3 years. And so it'll still have 2 years to go until maturity when we sell it. And let's say that we sell it for, I don't know, $960. Let's don't do that. Let's say $980. I have a reason for changing that. I don't want things to be too much like the case before. And so now, here's what we would do. Annual coupon interest. What is our coupon interest on this? $50, right? Just like before. 5% of $1,000. Hold it for 3 years, sell it for $980. What's our capital gain? We bought it for $900, it went up to $980. Our total capital gain is $80. But annualizing that, it's $80 over a 3-year period. See now why I didn't want to use $960 to sell it. I didn't want to be, $60 gain divided by 3 years, 20, just like before. So we're not doing that. But anyway, so it went up in value $80 over a 3-year period. How much is this? Anybody? $26 and how much? $26.67. The amount invested, $900. What? 76, 67 over 900. $8.52%. Anybody get a different number? I don't mean these to be, two different formulas. We sometimes use one term, sometimes the other. Okay? Now, we've used the same type of calculation as we did for yield to maturity, and all of these are coming back and basically following this general statement that we have here. But now we're not holding it until the maturity date. It's a holding period yield just for that 3 years, and sometimes that's called a rate of return. You particularly would call this a rate of return if it were a stock, because there is no such thing as a maturity value on a stock. You buy a stock and you sell a stock. And then there's two kinds of return from a stock, not coupon interest, but a dividend. That's the sort of guaranteed payment that they send you in the mail. Some stocks, that's a zero. They don't give you any dividend. Other stocks, almost all of your return is dividend. But this is, if we were talking about a corporate stock, this would be the dividend part, and this would be the capital gain. If it's a bond, we had an example of a bond. It's a 5-year bond, but we held it only 3 years. Now, something I want to emphasize, and it's this. You can calculate yield to maturity before you buy the bond. You can go, hey, if I buy that bond today and I hold it till it matures 5 years from now, my rate of return will be 7.78%. Because all those numbers are locked in. Those are certain. It's like, hey, I'm going to get $20 a year in capital gain if I buy it today and hold it for 5 years. So this is an ex ante or before the fact type of a calculation. I can calculate that before I buy that bond. And this kind of a calculation is ex post, or after the fact. This is looking back. It said, hey, I bought that bond, I paid $900 for it. Now, I never knew when I was going to sell it. I bought that bond, and maybe I'd sell it the next day. Maybe I'd sell it, and maybe I'd hold it till maturity. Maybe I'd hold it for a year, or 2, or 3, or 5, or 4.1. I didn't know. We never know when we're going to sell these investments. And we didn't know what the price was going to be. So this is after you sold it. Hey, you call your broker, I want to sell this bond, or I want to sell this stock. And you sell the bond or you sell the stock for $980, and then you go, oh, what was my rate of return? And now we're looking back. We're not looking forward, we're looking back saying, here's how I did. Are you with me? And so these are fundamentally different. And this is the only way to do it with a stock. You're always looking back at the stock. You never know what they're going to do with the stock, where its price is going to be, and there is no maturity. You can't say, I'm just going to assume I hold this to maturity. There is no such thing. So it's always going to be a looking back thing. Now, here's what you could do. You could say, if I bought this bond and held it for 3 years and sold it then for $980, here's my return. You can do that, but those are just all what ifs. 3 years, how'd you come up with that? $980, where'd you come up with that? And if somebody told you, I'm going to buy some General Electric stock, I'm going to pay $20 for it today, I'm going to sell it for $45 3 years from today, you would just say, okay, well, let's talk about something else, because you don't know what you're talking about. Nobody knows that. So the concept with a bond, something that's pretty safe or pretty sure that it's going to mature at $1,000, this has some meaning, this yield to maturity. But for most investments that we are going to trade, for all stocks and for bonds that you think I'm not going to hold to maturity, this would be the way you do the calculation. Except on test day, you've got to be able to do it either way. There's one other yield I want to talk to you about. and it's called current yield. And this current yield is focusing on cash flow. And so all that we do with this one is just say, how much do I get in that check they send me every year? Okay, in this particular case, you get a $50 check each year, and you've put $900 up to buy this thing. And so you're going to get back about 5.5 cents, a little bit more, 5.55%, 5.56%. You're going to get a little over 5.5 cents per dollar that you invested as a cash flow basis. And so this is really coming back to this yield to maturity and just saying, okay, forget about that capital gain. I know I'll get that someday, but it'll all show up at that point as $100. And what do I get in the meantime? And the people who focus on that are the ones who would be buying this bond in order to pay their bills. Like if you were retired and you went out and bought a bunch of bonds and said, hey, I'm going to get the interest from these bonds, the coupons, and I'm going to use that to pay rent or house payments or take vacations or whatever, you can certainly do that. What you can't do is go down to to a car dealer and say, I want to negotiate on a car. I've got thousands of dollars of capital gains coming 4 years from today or 5 years from today. Can I buy a car? They would say no. Can you make the payments? And so, can you make the payments? That would be this kind of a current yield that we'd be talking about then. And this is not particularly important to most people, but there are people for whom this is very important. It's the cash flow kind of income. Any questions about this? Yes, no?
So, on that one.
That one, when you say that one, you mean?
The current yield.
Okay.
That you're not really, you never invested that other $100, so why is it higher than 5%, the return?
Here's the thing, you're getting 5% of that, but you only put that much money out. And so you're getting $50 not on a $1,000 investment, that'd be a 5% return. You're getting $50 on a $900 investment. And so that gives you an extra 10% of that.
But you can't count on 5.5. You can't count on that coming back, can you?
It is coming back to you. You put up, what this is saying to us is, what is my annual coupon interest per dollar invested? And this is the dollars invested. Okay?
Is the dollars invested, is that like current value?
That's the value the day you bought it. That was its present value the day you bought it. Mm-hmm. Otherwise, you wouldn't have bought it, right? Or it could be less than its present value to you, but it's not more, because then you'd say no. Like you couldn't say, present value for me, $880, and they say, $900, you want to buy it? And you go, huh. You should say no. Okay? All right. Let's go on to one more topic, and then we're done with these interest rates. Hey, you want me to give you one of those problems on test day where I put that formula up here and I said you can, through trial and error, hit and miss, try to find that yield? Would you like to do that? Because there wouldn't be time for the other problems on the test. So you get 3% correct. You know, I mean, you got that one, but nothing else. Okay, This last topic that we want to talk about, we've just been talking about interest rates and yields here for the last few minutes. There's been this word, and all economists know about this word, maybe you know about it, but there's been a word that we haven't been saying because we know about it and we just think, we economists, hey, let's don't just keep repeating this over and over. We all take this for granted. And the word we haven't been saying is nominal. And by nominal, we mean just an unadjusted interest rate. Just the kind of number you'd read in a newspaper. See it reported on television. If they say Treasury bonds are paying 5.1%, that's the interest rate, but that's a nominal interest rate. Here's what we want to recognize. And let's just talk about, and I'll use 5% as a number here. Let's just say that you loan me $1,000 for 1 year, and I say, I'll pay you 5% to use your money. That's the interest rate I'll pay. So you give me $1,000, I do whatever for a year, you do whatever for a year, and a year from now I get back and I say, here's your $1,000 back, and here's $50 for letting me use your money. And that's more or less the way a bond would work or a loan, okay? Here's the additional twist, though, that we want to add to the story. While I've got your money, something else could be happening out there in the world. For example, there could be inflation, right? If I take your $1,000, and let's just say over here at the McDonald's restaurant, hamburgers are selling for $1 a piece. If I take your $1,000 today and go over to the McDonald's restaurant and say, what will this buy me? They would say, 1,000 hamburgers. And I'd say, well, thank you. Give me those hamburgers. I got 1,000 hamburgers. And then let's say that what happens over the next year is the price of stuff, shoes and socks and basketball tickets and cars and houses and hamburgers. Let's say the price of stuff goes up a lot. And let's just say hypothetically, it goes up 100%, prices double. $100 pair of shoes, $200. $20,000 car, $40,000. $1 hamburger, $2. So a year from now, I say, okay, let's get back together. Here's your $1,000 back. And of course the 50, but let's leave that to the side right now. Here's your $1,000 back. And say, oh, well, thank you. You're an honest person. You promised to pay me back, and here it is. If you go over to McDonald's and say, hamburgers, please, they would give you 500 hamburgers, not 1,000. So inflation is eating up or destroying, or some people would say taxing, the purchasing power of money. And so when you are thinking about this, am I going to loan money to that guy? Yeah, you want to be paid interest. You want to be paid a return on making a loan. But what you'd like to have is dollars when they come back to you that are just as valuable as they were before. Yeah, I'm willing to loan my money for 5%, let's say, but I want $1 to buy just as much as it does today. So you give me 5% and dollars of equal value, of equal purchasing power. And so even though we don't verbalize this very much, that's what we're going for. You wouldn't have to verbalize it if people just said, hey, there's 100% inflation. And I said, hey, loan me $1,000, I'll pay you 5%. You would just say, no. Why not? Well, because I can buy a bunch of stuff at that $1,000 right now, or I could loan it to you, and if I loan it to you, when I get it back, it's just worth half as much. It's still $1,000, but it just buys half as much stuff. I'm going to go buy that stuff. You could go buy shoes for yourself, or you could go buy whatever, canned goods, things, you know, that have some, things today, and you could use those over time, those shoes and so forth, and they would not lose purchasing power. They would still, a pair of shoes. But if you give me that dollar today and I give you back later, when prices have gone up, that dollar is not worth as much. So when we are setting these interest rates in our lending process, what we're really doing is this, is we want some real interest. I'm willing to loan you that money for 5%, let's say, but I also want you to pay me for a loss of the purchasing power. I want both of those things. So I'll tell you what. Yeah, I'll loan you that money for 5%, plus, if we've lost, what, 100% or 50% of the purchasing power of this, I want to be compensated for that too. So anyway, we've got this formula where the interest rate that we observe in the marketplace, and like I say, we usually don't say in nominal, we just say the interest rate, but it really has two components to it. And the real interest rate might be like 5%, and if you say, you know, prices are going up 100%, they're doubling, I want that inflation premium. And by the way, let me jot that term down. And this inflation premium, it's not looking back, it's looking forward. So this is really the expected inflation rate over the life of the loan. And by the way, this rate is annualized. Everything about interest is annual. Remember, we talked about that before, the annual return per $1 and so forth. Anyway, so we're always talking about an annualized number here, and so we're talking about an annual inflation rate. What percent increase in prices is going to occur? And so if you say, I'm willing to loan for 5%, but prices are going to double, then what you say is, I'll tell you what I'll do. I'll loan you that money for 105%. Now, you're protecting yourself, right? You're protecting yourself against me giving you dollars that are this, or you give me dollars that are this big, and when I give them back to you, they're that big in terms of their purchasing power. You've got to protect yourself, and that's why you're doing it. Would I be willing to pay that much? Yeah. Here's why. I can go buy 1,000 hamburgers today. If I wait till next year to go buy those hamburgers, I can only buy 500 with that same. I want to beat inflation. I want to get there before they raise the price. So I'm willing to pay extra. I'm willing to pay this little bonus to get that money. If I want to go buy a house and the price of housing is going up 30% a year, I'm saying, oh my gosh, I want to buy a $100,000 house. If I wait till next year, it's a $130,000 house. And so if you say to yourself, I think there's going to be 30% inflation, I'm going to tack that 30% on the interest rate, I say, okay, I'll pay 30% more for that money because I want to buy that house and its price is going up 30%. If I wait for a year, it's going to be $130,000. Okay. So this is something that both of us, now neither one of us are going to verbalize this. If you said to me, hey, there's going to be 100% inflation, I would say, you know, you're just making that up. We don't know that, do we? I'm guessing more like 20%. And I'm negotiating now. And I'm still thinking 100%. But I'm not going to say, yeah, you're probably right, could be 200%. You're just going to charge me more. So I say, yeah, I think you're a little bit crazy. Not a little bit, maybe a lot. Probably maybe 10%, 20, 30 at the outside. Well, and whatever you say, if you say 30, I'd say 20. And if you say 20, I say 10. That's what negotiation's about, right? So anyway, but when we see an interest rate, and these are outrageous numbers that I've put up here, when we see an interest rate, it's got an inflation premium built into it. Okay. If we look over long stretches of time, and this is, how about this, the interest rate in a non-inflationary environment. If we look over long stretches of time and find those periods where there's not inflation, people not talking about it, it's not on the horizon and so forth, what we see is that the Treasury can go out there and borrow money at about 2 to 3%. It depends on the term to maturity. But if we were just talking about a one-year Treasury bill, then around 2%. One-year Treasury bill. And that's where the government is issuing, not a bond, but it's called a bill, but it's kind of like a bond. It's a debt security. But when the United States Treasury is borrowing money for 1 year at a time, and we go back over the last 40, 50 years, then they're paying about 2% to borrow money on a real basis. And then what happens is we tack on inflation. And if what you have is an inflation rate of about, let's just say a 3% period, and by the way, over the last generation, the inflation rate was approximately averaged 3%. So over that generation, what you would expect to see is that there'd be about a 5% nominal interest rate on those securities. And the people who are lending their money for 5%, they don't think, I'm getting ahead 5%. What they're thinking is this: I loan my money for 5%, I'm going to lose 3% because by the time I get my money back, prices have gone up and I'm losing purchasing power. I'm just going to end up with 2%. Everybody okay on this? And this is what's important to us, the real interest rate. Now, there's only one problem with this, and then we will be done. Here's the problem. Nobody knows what that rate's going to be. That expected inflation rate is a forecast. Can be right, can be wrong. What's the inflation rate going to be from today for the next year? I don't know. I can guess, but I don't know. I've guessed before and been wrong. In fact, I'm always wrong when I guess, because when I guess, I put some decimal point on, like 2.14%. Well, it's not 2.14, it's 2.2, or it's 2.08, or whatever. So anyway, this is always a guess. And so, but this is the theory of it. And I'm going to write it down. Here's the nominal interest rate equals the real interest rate plus the expected inflation rate. That's in theory how it works. Now, in practice, how this is applied is, and by the way, I used the term before, here's ex ante. Ex ante is before the fact, looking forward, forecasting inflation. What some people will do is look back. The ex post situation. And what they might say is something like this: hey, I loaned my money for 5%. It turned out that the actual inflation rate was, let's say, 4%. We locked this in. This is the agreement. Here's nominal interest rate. I loaned you the money. We have an agreement. We shook hands. We wrote it in a contract. End of story. And then at the end of the year, you pay me back. We look back and we say, hey, look, over the last year there's been 4% inflation. And so then after that, we calculate the ex post real interest rate. And it's just the difference between these two things. It's got, I mean, whatever makes 5 and 4 balance out, wouldn't that be 1? That's what it is. It's the last thing we calculate. Now, the ex post. This is after the fact, looking back, here's how we turned out. And that ex post rate, 1%, is not equal to the ex ante rate, maybe of 2%, because we were wrong in our forecast. So there's two different ways of looking at this real interest rate idea. Nominal interest rate equals the real rate plus inflation. Is it actual inflation or is it forecasted, expected inflation? Okay. This is known as the Fisher equation. And it's named after a guy named Irving Fisher. He was a U.S. economist. And I'm not exactly sure what year he wrote this, but about 1907. I'll put a question mark there, but sometime along in that period, about 100 years ago. Okay. I've got a couple minutes, so let me introduce the next topic. Are there any questions about this? About Irving Fisher? Irving Fisher was a very smart economist that wrote a lot of articles, invented things. There used to be a Rolodex kind of thing that secretaries would keep on their desk. It's a little plastic thing, or probably metal when he invented it, with a lot of little cards around it, and people would write down their contact information for different people and kind of spin it around, like, here's Bob, and here's Steve, and here's Sally, and so forth. Anyway, he invented one of those products and did a lot of things, became very wealthy, and then the Great Depression came along and I think kind of wiped him out. Stock market crash and all that sort of thing. Taught at, I believe, Yale University. Here's what we want to talk about now. We just talked about interest rates, about how to calculate them. 4%, 6%, 8%, how to calculate it. But the real question, or the next question we want to talk about is, why are interest rates whatever they are? Why are interest rates 4% or 6% or 8%? And so what we are going to do is, and I've already kind of alluded to this previously, we're going to develop a supply and demand model we're going to put the quantity of the good that we're talking about on the horizontal axis. The good is credit, dollars for loan. And what we're going to put on the vertical axis is the price of borrowing those dollars. And there's going to be supply and demand. And so the why are interest rates 4 or 6%. Supply and demand is the why. So what we will do is we'll talk about the components of supply, and we'll talk about the components of demand. And then we'll put all that stuff together. We'll talk about supply and demand independently and put them all together and get an interest rate. And that's next. And I'll see you next time.